So, global markets are really on a knife's edge right now. Today, we're going to dissect the anatomy of this crisis to understand the powerful forces that are actually at play. Okay, so what we're looking at today, March 3rd, 2026, is what many are calling a perfect storm. Let's break down exactly what happened and why it sent such massive shockwaves across the entire financial world. All right, so let's dig in. What exactly were the ingredients that triggered this perfect storm? Wow. I mean, this all happened incredibly fast. It kicked off with a joint U.S.-Israeli military operation called Epic Fury. Right after that, reports came out about the death of Iran's supreme leader. And then, the response? Iran's IRGC announced a total closure of the Strait of Hormuz. That's one of the most critical choke points for global oil, and it immediately sent energy markets into a frenzy. And here's the immediate aftermath on the U.S. markets today. You can see the big indices took a hit, down around 1%. But look closer. The real story here is in the tech sector. The Philadelphia Semiconductor Index got absolutely hammered, plunging almost 4.6%. And see that little green number, the dollar index, USDU, ticking up? That is a classic flight to safety move. Now, as bad as that looks for the U.S., check this out. The sell-off in Europe was way, way worse. We're talking over 3% across the board for the major markets there. And there are some very specific reasons for that, which we're definitely going to get to in a moment. Okay, to really get what's going on, the why behind this crash, we need to look beyond just the headlines. We're going to break this down using 4 really powerful economic theories. Let's start with the first one. First up, we've got this idea from Gunter Dweck called systemic overload. Think about it this way. Our modern markets are so interconnected, so driven by algorithms, that they're just swimming in data. This theory argues they can't always tell the difference between a little bit of noise and a true catastrophe. So they're primed for massive overreactions. And this quote just nails it. The market wasn't doing some careful math on oil prices. Nope. It basically panicked and priced in a complete doomsday scenario. Fear just fed on itself, and it spiraled exponentially. It was a classic case of a self-fulfilling prophecy. Okay, our second lens comes from a totally different school of thought, the Austrian school. They'd argued that the big AI rally we've all been watching was really just a classic case of malinvestment. Basically, a bubble created not just by real innovation, but by a flood of artificially cheap money from central banks. This really gets to the heart of their argument. From this perspective, the market was already a bubble, just waiting for a pin. The oil shock? That wasn't the cause. It was just the pin that finally popped the bubble. It basically cornered the Federal Reserve, taking away their ability to cut rates and keep the party going. The crash was coming anyway. This was just the trigger. But hold on, not every theory is spelling doom and gloom. Ken Fisher's financial waltz concept tells us to take a step back. He says, these kinds of geopolitical crises, they often create a lot of short-term noise and volatility, but they rarely knock a real bull market off course for good. So from this angle, today's big drop is a classic overreaction, driven purely by fear. A proponent of this view would probably point out that, hey, the U.S. is a major oil producer now, not like in the 70s. So once this initial panic dies down, the market's going to go back to looking at what really matters in the long run, corporate profits. And for our last lens, we've got George Soros' theory of reflexivity, which is fascinating. It's this idea that investors' beliefs don't just reflect reality, they can actually create it. It's a feedback loop where our perceptions start to shape the fundamentals themselves. And this is a perfect example of how that works in the real world. A very simple, very scary story took hold in the market today. And because everyone believed that narrative, they started acting on it. Companies and investors pulled back on spending and investment, which in turn could actually cause the very recession they were afraid of. Okay, so keeping all those theories in mind, let's circle back to that question from earlier. Why did Europe get hit so much harder than the US? Well, the analysis really boils it down to 3 big vulnerabilities. First, energy insecurity. After moving away from Russian energy, Europe became really dependent on Qatar, which is now at the center of this crisis. Second, financial fragility. There are real fears that an energy shock could cause a wave of defaults in an already shaky banking system. And third, you just have this underlying negative social mood that basically amplifies any bad news that comes along. All right, so we've talked about the theories, the why, but how do the pros, the quantitative traders, actually measure and deal with this kind of chaotic environment? Let's move from theory to the hard data. Yeah, how do you put a number on this new level of risk? Well, let's take a look at how some of these advanced statistical models try to do just that. First, we have to get our heads around this concept of fat tail risk. Normally, we think of risk like a bell curve, right? Where huge crashes are super unlikely, they're way out on the thin tails of the curve. But in a fat tail world, the unthinkable becomes a lot more probable. The market's now playing in that really dangerous thick tail zone. And the models actually put a number on it. A Monte Carlo simulation is now calculating a 34% chance that the S&P 500 drops another 5% or more in just the next 30 days. To be clear, last week that probability was only 12%. That is a massive, massive jump in perceived risk. So with that kind of risk on the table, what does a professional, data-driven response actually look like? The report lays out a really interesting strategic framework as an example. Okay, and this is really, really important, so I need to be crystal clear. What we're about to discuss is an example of a professional methodology, and it's for educational purposes only. This is not, I repeat, not financial advice. It is not a recommendation for you to buy or sell anything. All right, so the strategy basically breaks down into three parts. First, you've got to hedge that fat tail risk we just talked about. That might mean buying protection, like put options, which are like insurance against a major crash. Second, you can run what's called a long short play. So you'd go long on sectors that might benefit, like defense and energy, while shorting the ones that are going to get hurt, like airlines and cruise lines. And finally, there are currency pair trades, using models to spot temporary imbalances between currencies and stock indices. So when you put it all together, what we saw today, it was never about just one thing, right? It's this incredibly complex dance between geopolitics, economic imbalances, and frankly, raw human psychology. And that leaves us with a pretty sobering final thought. In this hyper-connected world we all live in, maybe the next perfect storm isn't a question of if, but when.